Hello everyone. In this video, I am going to present you about fundamental analysis. In the stock market analysis, fundamental analysis is playing key and significant role for identifying the security's value. Normally, the fundamental analyst attempt to study everything that can affect the security's value, including macroeconomic factors like the overall economy and industry collaborations and conditions, and individual specific factors like the financial position and management of the companies. In addition to that, the fundamental analysis is a robust method for evaluating the securities by determining their intrinsic value. I would like to tell you what do you mean by the intrinsic value in this context. The intrinsic value is nothing but the price of a rational investor is willing to pay for an investment with taking the level of the risk. In other words, we can say that the intrinsic value is different from market value of a security. The intrinsic value is also going to consider the future values of and discounted rate. What I wanted to say here is today 1 rupee is different from after 1 rupee is after 1 year. Today you are going to invest 10,000, but that will not be equal after 1 year. So taking into the discount rate factor and future cash outflows and inflows, they are going to decide the intrinsic value. Means if intrinsic value of a company's stock is more than the market price of the share, now you can buy the product or buy the security. If intrinsic value is less than the market value, if you have the security, you can sell it off or you should not buy that security. Fine. Let me move on to the three phases of the fundamental analysis. This is looking into three main areas how fundamental analysis will be done. The first and foremost is economic analysis, second one is a industry analysis, third one is a company analysis. These are the three components of fundamental analysis. I am go one by one in detailed manner. First one, in the economic analysis, they are going to take all the economic environment and developments of the economy. The first thing is growth rate of GDP, growth rate of gross domestic product. Means the domestic product is a measure of the total production of finished final goods and services in the economy during a specific period. Usually it is a 1 year. So the higher rate, the growth rate of GDP, if it's always more favorable for the stock market. Now the India's GDP growth rate is estimated to be 8.2% in 2023-24. It is up from 7% in 2022-23. So normally this will be the favorable condition for the stock markets. Next, another one I would like to emphasize here, industrial growth rate. The higher growth of the industrial sector is always be more favorable to the market. As per the economic survey, it has reported 9.5% growth rate. So it is always good for the stock market as far as the industrial growth rate is concerned. Move on to the another one. That is a third one is a agriculture and monsoons. Basically, generally, agriculture accounts for about quarter of the Indian economy, and it is a important linkages and direct as well as indirect with the industry. If it is agriculture production is significant increases, it leads to the industrial production, industrial improvement, and industry has been improved a lot. In addition to that, this will be the once industrial sector is moving forward, this will be more favorable to the stock market. So the agriculture totally depend on the agriculture production is also uh, depending on the industrial sector. So if agriculture production increases, industrial sector will also increase. That will be ultimately leads to the stock market favorability. The fourth one is a saving and investment. The always in this analysis, analysts always know that how much savings, how much they are allocated their savings over various instruments like equity, bonds, bank deposits, and small saving schemes and bullion market. They have to see that. See, depend on the greater allocation of the equities and other, almost it will be favorable to the stock market. And fifth one is a government budget and deficit. If government budget, if it is expenses more than the revenue, it will be the deficit. If it is expenses equal to revenue, balanced budget. So expenses is less than the revenue, obviously it was if it is a surplus budget. So what I wanted to try it over here is the government should maintain the good budget, then that will be the good for the stock market analysis. Having said that, let me also go for the price level and inflation. The effect of the inflation on the corporate sector will be uneven. You see, some industries may benefit, others tend to suffer. Industries that enjoy strong market for those products which don't come under the purview of the price control may get benefit. On the other hand, industries have weak market conditions which is come under the purview of price control tend to lose. On a whole, above all, I would like to say here, it appears that mild level of inflation is a good for the stock market. The next one I would like to emphasize here is interest rate. A rise in interest rate always the decreases in the corporate profitability, that tends to decrease in the that will be the adverse impact on the stock prices. On the other hand, a fall in interest rate will always favorable to the stock market. Then going forward, balance of payment, forex reserves, and exchange rates. So the balance of payment deficit always decrease the foreign exchange reserves. That will be the not favorable impact, and favorable to the not favorable to the stock markets conditions. And another one I would like to emphasize here is infrastructural facilities and arrangements. See, well developed transportation and communication system are like railways, transportation, roads, networks, inland waterways, port facilities, air links will always give good impact on the stock markets. Then the other one in the last one in the economic analysis is the sentiments. The sentiments of consumers and businessmen can have an important on economic performance of the economy. So, the higher business confidence always translated into greater business investment, that will be the good impact and good effect on the economy. So, this is about the economic analysis. Moving forward to the industry analysis. In the industry analysis, it has been divided into three parts: industry life cycle. First, industry life cycle. This contains four stages. Pioneering stage means startup stage, growth stage, maturity, and decline stage. In the pioneering stage means startup stage, the technology and product were relatively new. As a result, this results that this is a keen and often sometimes it is a chaotic conditions, and sometimes it is a competition. So normally, most of the few entrants may survive at this stage, others may leave from this stage. And next one is a growth stage. In the growth stage, uh, they survive. Those companies who survive, they will be follow intense competition, which is significant expansion of their sales and profit. And maturity, almost they are getting to the maturity stage. Their profits will also increase to the maximum extent. After that, so what will happen, the industry will decline stage, because that there is a high satisfaction of the demands, and encroachment of new products and changes in the consumer preferences, ultimately and eventually the decline stage will coming into the industry. So keeping those things into the consideration, the analyst should invest what kind of industries they wanted to invest, they have to identify. And second one is a study and structure of study of the structure and characteristics of an industry. They have to study the structure of the industry and nature of the competition, nature and prospect of demand, cost, efficiency and profitability, technology and research. In these things, they have to consider so many things. They have to focus on the licensing of the policy of the government, entry barriers, pricing policies, key determinants of the demand, major customer and their requirements, what are their preferences, and coming to the cost efficiency profitability, they have to identify the productivity of labor, turnover of inventory, behavior of prices of inputs and outputs in response to the inflationary pressures. Coming to the technology and research, they have to identify the degree of technological stability, proportion of sales growth attributes to the new product. These all things will be considered in the second part of the industry analysis. And the third part, which is most important one, profit potential and industries. This is also known as a Porter model. So in this, industry depend on the combined strength of the all five basic competitive force. Means the first force is what is the threat of new entrants. Second force is a rivalry among the existing firms. They have to have great competition among the existing firms. The third one is a, if any substitute products are available, they are going to get pressure. Pepsi and Coke, they are the substitute products. So they what will happen, they are going to get so much pressure in the industry, and bargaining power of the buyers, bargaining power of the sellers. These are the five basic competitive forces, depend on that the industry will be prevailing. So the last analysis is a company analysis. In this, there are six methods follows in the financial analysis in the company analysis. The first one is a comparative statement, trend analysis, common size statement, funds flow analysis, cash flow analysis, and ratio analysis. I'm going one by one quickly. First one is a comparative statement. In the comparative statement, what they will do is the finance statements in the financial position at different periods of time. The compare financial data over different periods. The main thing they have to take into the consideration, two financial and balance sheet and income statement or prepared in a comparative form for financial purpose. They'll take the absolute figures and changes in the absolute figure and increase or decrease in absolute figure in terms of the percentages, they will calculate in the comparative statements. This is the main thing, is financial health changes and growth trends will be prevailing here. Then go back to the trend analysis. In this, in this analysis, the direction upward or downward trend involves in the computation of percentage relationship to each statement item with the taking into the base year. Then common size statement, here the base figure will be taking into the consideration, and the total assets or liabilities are taken as 100. Depend on that, they will calculate liabilities percentage and assets percentage. Then funds flow analysis. In this funds flow analysis, uses of funds and sources of funds. Sources of funds like issue of debentures, increase in net worth, addition to funds, will be considered as a sources of funds. And uses of funds, you have to addition to the assets, addition to the investment, decrease in liabilities will always be the uses of funds. That will be analyzed in the fund flow analysis. Then cash flow analysis, the cash inflows and outflows depend on the different activities. The cash flow statement explains how the dividends are paid, how the fixed assets are financed. The analysis, they have to know that the real cash flow position of the company. This will all be the important factor. And the last one is a ratio analysis. It is a process of establishing and interpreting various ratios, like different ratios, profitable ratios like gross profit ratio, operating profit ratio, net profit ratio, and liquidity ratios like current ratio, liquid ratio, and efficiency ratios, debt equity, assets to equity, capital gearing, and return on investment, return on equity, turnover on fixed assets will always be the these are the different ratios. They will identify the operational efficiency and margins with respect to the companies over a period of time and between the companies within the same industry group. This is in total about the fundamental analysis, the company economic analysis, company analysis, and industry analysis. The difference between the company and industry is company is an one, and industry is a set of companies, set of firms is known as a industry. These three analysis will reflect in the fundamental analysis. Thank you for watching. See you in the next video. Thank you so much.